So where do things stand now as fears of widespread losses continue to reverberate in the banking sector? Joining us here on set is RXR's Scott Rechler. Scott, good to have you back.
It's good to be back.
It's been a little while, but you've been making the rounds. And, you know, you're unsparing your commentary. Let's see. It's an existential moment, you told 60 Minutes recently. You obviously have talked to us about the slow-moving train wreck. Why are you so outspoken and seemingly negative about an industry of which you're an important part?
I'm sort of the view you take a eyes wide open approach, and you know when you can really identify what's happening and understand it, then you can take advantage of the opportunities. And you know I said that last year about the slow-moving train wreck. And what was interesting is that the train in 2023 really never left the station because the markets, I think, became a little bit paralyzed with the surge in inflation, interest rates, what was happening with the war in Europe, and then the financial shock in March. And then as we got into the fourth quarter, you know, people began to capitulate and realize, okay, rates are not going to go back to where they were, so values aren't going back to where they were. Banks began to take reserves. The Fed said, okay, we're at least topped out in terms of where we think the rate rises are going to be. And so now it's going to start. So now the train is going to start to slowly leave the station, but it's going to be a process that is a couple-year process as $2 trillion of commercial real estate loans that were financed over the last 15 years at rates that were much lower than today are going to have to get refinanced and are going to need, you know, injections of capital or restructurings. And so it's going to be this rolling restructuring
and a lot
process.
More potential equity given the decline overall.
And
that's one of the key questions. I mean, you obviously have some properties you feel great about, but I think there's a building right across the street that you walked away from.
Right. Well, actually, we didn't walk away from it. And it's a good example, which is we went back to the lenders and said, okay, here's a property that in its current value doesn't work. And the lenders went through a process and we said, listen, we can go sell it. There was no buyer, right? So now we're finalizing a deal with the lender where we'll put in new money and we're going to convert it to a mixed-use property for office and multifamily, right? So, and that's the interesting thing. There hasn't been one situation where we've gone to a lender where we've said, okay, values have shifted. We need to reset those values to reflect the current environment, where they've wanted to take a building back because they don't want it back. They don't want to invest the capital to have to go do it. They don't have the expertise to do it. So if you're a borrower who's willing to invest money, you know, banks are willing to reduce their loan balances to reflect the current environment, and you'll, you know, recreate the value there. But you got to be selective.
Is it too soon then? I mean, you just started a new distress fund, I think, with Ares Management. Is it a little too early, or are you seeing real opportunities now to put capital to work in the way that you just described with the building here on Broadway?
Yeah, so I think, as I said, we're just starting to see this capitulation, right? The reserves, banks have been taking every quarter. You hear it from the big banks, you hear it from the small banks. And so now they're going to want to reduce their commercial real estate exposure. I mean, they're getting a tremendous pressure from the regulators to reduce the commercial real estate exposure. So I think it's the timing is right. You know, when we came in the market in 2009, August of 2009, for the first time, we were alone in the market. We ended up buying $4.5 billion of properties and then sold the 49% interest and got all our money back out in 2014, right? So it's a little bit like that. The difference this time is there's no big surge of liquidity coming in that all value is going to go back up. So this is really a stock picker strategy. You got to pick the right property that's in the best location, that has all the attributes that a tenant wants to go to, because not every
But what's different now also is